This video is for educational purposes only and should not be considered financial advice. Which ICT displacement should I use? Many traders take the wrong trades by not identifying the correct displacement. In this video, we will be going over the key steps involved to make sure that your displacement is the correct one. When trading ICT and trying to take an entry, many traders look for a displacement above a swing high or below a swing low. What many traders fail to realize is that displacement only happens under certain conditions. First, we need to understand what displacement is. Displacement is the market maker trying to move price quickly in the opposite direction after trapping traders in the wrong direction. This is why ICT instructs us to look for it. It is one of the clues for us to be able to see where smart money is now getting involved. In order for displacement to occur, the following conditions must be met. Price has reached a specific level on a higher time frame and is now reversing. Liquidity has been taken. There is a fair value gap created with the displacement. Higher time frame level. In order for smart money to create displacement, it has to meet a higher time frame objective, usually by taking liquidity or rebalancing price. Liquidity has been taken. In order for displacement to occur, smart money needs fuel to move in that direction. That fuel is in the form of retail stop losses. Smart money will take the stops of retail traders and use it to fuel the move in the direction that it wants to go. Fair value gap created. The displacement move happens so quickly that it creates a fair value gap. This gap should stay open if price is going to continue in that direction. Let's take a look at a few examples of how to spot displacement and also how to spot moves that are not displacement. Here's an example of the right displacement to pay attention to. Here we have price reaching past the London session. And this is why we say it's important to pay attention to time and price. The London session high gets taken out, but it is not during the pre-New York Open. That high is eventually taken out, and then there is the displacement. This could also be considered displacement. However, time and price is what's important. So during the pre-New York Open, we have displacement. Now what displacement looks like is a strong move to the downside. And this move right here is 2 bars that takes out a swing low. That's why we have a break of structure. This swing low is taken out by 2 candlesticks. And ideally, we want to see that second candlestick close without a wick or with a small wick. But this actually has 3 candle closes, which shows you that there is a displacement. The market makers are now stepping into the market and making their footprint. A fair value gap is also created, and importantly, liquidity has been taken. So price retraces back into that fair value gap, and that is an entry. But if you're a little squeamish and don't want to enter so quickly, you can wait for a swing high to be created. And again, a swing high is a candle that has lower candles to the left and to the right of it. This is a swing high. This is your entry. Once this candle closes, that is your confirmation that this is a swing high. Price aggressively moves to the downside. We also had a target below the London session for our liquidity, but London was taken and the Asian session liquidity was taken, as well as previous days session liquidity. Now, looking for the other side of the trade, waiting for the New York session to occur, we had a retracement. Now, some people look at this with two big candles to the upside as displacement. That is not displacement. And even with this third candle, this is the swing high right here. This level is the swing high. Those three candles, and actually four candles, did not break that swing high. That is not your displacement. Now, if you wait after this retracement into this fair value gap, you can see this candle and then a smaller candle occurs, and you could consider that displacement, but this is a small candle. It does not give you any confidence that price is moving to the upside. However, when these two candles happen after that, that could be considered displacement. However, the move has pretty much extended itself, so we would want to wait for another pullback. Right here, we see equal highs created. Then price pulls back into this first fair value gap, and it goes all the way down into this fair value gap. That could have been an entry. Price takes off, breaks structure, and then you're looking at a possible move to the upside. But this right here is true displacement. You have 1, 2, and 3 candles that break a swing high. That's true displacement. And as you see, price retraces all the way back again into this fair value, and that is the safest entry. And if you want to wait for price to cross the 4 EMA, you can do that here and still get a good risk to reward trade to grab this liquidity. In another example, we see price moving to the upside during the London session, creating the high of the day. Then during the session in between, prior to the pre-New York Open, there is displacement, but again, time and price. But what you can look for is a retracement back into the fair value gap that was created. You had 3 candles that moved to the downside and broke structure. Then price created liquidity, then went up and grabbed that liquidity, but also going into the fair value gap, then moving to the downside. This move with a small candle in between the large candle move, that is not really displacement. Some people will say it's displacement because it breaks structure and it has large candles. But true displacement is a non-stop move without a break in your candles. So you can wait for this move that happens here, and this is true displacement. Large consecutive candles to the downside. You get a retracement back into this fair value gap, and then price takes off, moves lower, it retraces once again, but eventually it gives up the ghost and goes all the way down. So again, out of all of these moves to the downside, this one was the best move for displacement. To recap, displacement is key to determining the direction of price at the specific time you are intending to trade. There are 3 key criteria that must be met in order for the move to be true displacement. They are higher time frame level reached, liquidity taken, fair value gap created. We hope you've enjoyed watching our video. Please like and subscribe for more videos like these. If you have a question, comment, or something you would like for us to cover more in depth, please post it in the comment section below. Thank you for watching.